Good afternoon, everyone, and on behalf of the Commonwealth Bank and our community, welcome to our third webinar in the Managing Your Not-for-Profit Balance Sheet series with Professor David Gilchrist, co-convener Not-for-Profits at the University of Western Australia and co-author of the Not-for-Profit Balance Sheet, a resource for directors and CEOs. I'm Angela Bennett, Senior Manager, Schools and Not-for-Profit Sector Banking here at Commbank, and also joining us on the line is Lachlan Pollock, Project Manager for the Festival of Community Directors at our community. To start, I'd like to acknowledge the traditional custodians of the lands where everyone is joining us from for today's webcast, and to pay my respects to elders past, present and emerging. Before we get underway, you should be able to see a section to post questions on the toolbar on the right-hand side of your screen. So please send your questions in throughout the presentation, and David will try to get to as many of these as time allows. There's also a survey at the end of the presentation, and if you could take a few moments to complete this, as it does help us to better tailor future presentations to meet your needs. And of course, no presentation from the bank would be complete without a disclaimer, which should be on your screens now. So we've got a lot to get through in this session as we explore the not-for-profit balance sheet and the profit and loss report. So without further ado, a very warm welcome, and over to you, David.
Thanks very much for that warm introduction, Angela, and thank you to Commonwealth Bank and my community directors and my communities for the opportunity to present today. I really appreciate it. This is the third in our series looking at balance sheet for not-for-profit and charitable organisations. And today I want to have a look at the profit and loss report and how that articulates with the balance sheet, but also to look at some of the practical aspects associated with the profit and loss report, and particularly how CEOs, those charged with governance and others in an organisation can consider what kind of profit targets their organisation should have. Before I go to that, I would like to acknowledge the Whadjuk people of the Noongar Nation, the First Nations people who have looked after the land from which I'm presenting here in Perth in Western Australia, and also to acknowledge all of those First Nations people around the country upon whose land which the participants of this session might be sitting. The other people I would like to thank is just to reiterate my thank you to Commbank for their support in this project overall. It's been a long-term support in pulling this together and maintaining it. To the sector for all of the work that they've done in contributing to this tool particularly, and also to the subjects that we're looking at in these seminars. I think that input has been really invaluable. And finally, I'd like to acknowledge my colleague, Dr. Dane Etheridge at Curtin University, who also helped me pull together the balance sheet tool that we are looking at in the context of this presentation. That tool is available and I think provided with this presentation. And as you can see, there's the cover there. It really is intended to be a resource for directors and CEOs in not-for-profits and charitable organisations. Indeed, the resource really does three things in our minds. It describes the purpose, nature, and governance of the balance sheet itself. So the balance sheet is a really important tool and also a really important reference point for those charged with governance of not-for-profit charitable organisations as they ensure their sustainability going forward. It also tries to focus those people who are untrained in accounting as to what they should look for, and finally to suggest some key questions for those people in relation to your organisation. So I think this is a really important tool for those people in the not-for-profit sector to focus on and to consider in the context of running their organisation. Of course, the final point is that it's a starting point only. Make sure you get advice and make sure that you're happy with the answers to the questions that might be arising in your mind as a result of using this particular tool. My focus today, as I said before, is on the profit and loss report in the context of the balance sheet. And I guess in that respect, really I'm interested in talking about how the balance sheet and the profit and loss articulate, but more importantly, how the profit and loss report can help you to ensure that you're building the balance sheet. And so to that extent, I'm really keen also to reflect back on presentations 1 and 2 in this session, and which you can get recordings of, in relation to, in the first presentation, looking at what the balance sheet actually is, and in the second presentation, looking at how you might plan for the balance sheet or budget for the balance sheet to build your capacity in your organisation for sustainability. So this focus is very much around that sustainability issue, and remembering that sustainability is about ensuring your organisation can continue to provide the services and supports that it purports to and wants to provide in the context of its purpose. To that extent then, the key word for me today is really around profit, or at least for a large part of this presentation. Indeed, the profit of a not-for-profit or charitable organisation is an absolutely critical element for those charged with governance to consider. And there is still quite a significant set of mythology built up around the not-for-profit and charitable sector, including as recently as yesterday, speaking to someone who asked the question as to whether or not a not-for-profit should actually make a profit as a charitable organisation. First and foremost, and in terms of the absolute bottom line message from this particular seminar, I'm really keen to confirm that not-for-profits and charities must make a profit in order to be sustainable. That doesn't necessarily mean that they make a profit every year, but it does mean that they need to be making a profit year on year in order to be able to build their balance sheet and do all of the things that you need to do to be a sustainable organisation in the context of the definition of sustainability as I've just described. The second thing to remember is that not-for-profits and charities in Australia, as they do in New Zealand and in most of the developed world, operate in market economies. And any organisation operating in a market economy needs to make a profit in order to ensure that sustainability. So I guess first and foremost in the context of this presentation, I'm very, very keen to ensure that everyone goes away clear in their mind that their organisation should be making a profit. Of course, the question is how much profit and how to plan for that profit. And we'll talk to some of those issues shortly. But in the first instance, I think this is a really, really important point. So the objective in the context of sustainability is really important. And I've already spoken to that a little bit, but just to make sure that we're all on the same page in the context of what we consider to be sustainability in not-for-profit and charitable organisations, it's for those organisations to be able to provide the right services in the right quantity, at the right quality, and at the right time. That is, that any organisation to be sustainable, it needs to meet these four criteria. A not-for-profit or charitable organisation that is unable to meet these criteria is arguably unsustainable because it's not really achieving its purpose. The survivorship of the corporation is not as important as the survivorship of the purpose. And so when we talk about sustainability, that's what I'm certainly talking about, the context in this instance of profit. So I guess there's a couple of other aspects that are really important there. The first one is that there's sufficient cash and an appropriate asset mix in the context of the organisation. That is, you need to be able to pay your bills as and when they fall due. No organisation wants to become insolvent, but also to have sufficient cash to maintain an appropriate asset mix, to be able to maintain the organisation and build the organisation to continue to be able to be sustainable in the context of its purpose. And so in the context of profit, I think this is a really important thing to be considering. Let's have a look at that in terms of the elements for balance sheet budgeting that we talked about last seminar, I'm sorry. In the last seminar, I spoke about balance sheet budgeting because we determined that that was a really important aspect of ensuring that sustainability going forward. In this context, in terms of balance sheet budgeting, I wanted to confirm that profit builds the balance sheet capacity by ensuring, for instance, that you have cash flow and working capital to be able to maintain solvency in your organisation, to be able to ensure that you've got sufficient capacity to pay for things like leave entitlements in the longer term, and also to cover things like depreciation estimates, that is, assets and replacement of those assets as time goes on. But you also need to be able to do things like not only replace assets, but to re-engineer the organisation as funding and other arrangements occur, as demand changes within your purpose audience, and as the kinds of services change, and as perhaps skills get more developed, as processes become more developed, then you need to be able to train your people and change your organisation accordingly. So sustainability is not just about making sure you're solvent, It's not just about making sure you're able to retain assets and build your asset base, but it's also about being able to ensure your organisation is appropriately organised and has the appropriate skills mix to be responsive to changes in need, changes in funding arrangements, and other governance changes that might impact your organisation. And again, to make sure that we're closing that circle, profit is a critical part of ensuring this strong balance sheet capacity going forward for your organisation. And so profit over the longer term, looking at a 3 to 5 year financial plan, rather than just looking at budgets on an annual basis, is a really critical part of that planning process as well. So let's look at profit. I think this is also a really important consideration. The word profit often gives jitters to people for a number of reasons, and we'll explore those reasons right now. Often, because people don't feel comfortable in charities and not-for-profit organisations, they talk about surplus rather than profit. And surplus has a really important accounting meaning in my mind. It relates to cash held that is not required by the organisation. Typically, a good example in relation to such cash might be in relation to a project. For instance, a government or a philanthropist might provide your organisation with a set amount of money to do a particular thing on the proviso that once that thing has been done, any excess cash is handed back. That's surplus cash in the true sense of the term. Profit, on the other hand, is a measurement of the financial gain of the organisation. And it's really absolutely critical that any charity or not-for-profit organisation is adequately managed and governed to achieve that financial gain. Now, there's a lot of questions and a lot of issues around this idea of financial gain, and particularly what the quantity of financial gain should be, and also how should you balance that financial gain, so the provision of services that might result in a profit, as compared to those services that are equally demanded, but are maybe not financed in a substantive way to be able to deliver a profit. That balance between profit and purpose is a really important consideration. An example of profit in this case is, of course, income less expenditure. That's typically the profit and loss report or the income statement in accounting terms that provides you with that set of income that's come in, less the expenses that have gone out to generate that income. So what are some of the key questions around profit then? First and foremost, what is our achieved profit and what does history tell us? I think this is a really important starting point for any volunteer director, CEO, or even CFO of an organisation. There's no point in planning to achieve a profit that is either unachievable or that is blue sky. You need to look at what your organisation has achieved previously, and history in accounting terms is always a good indicator of what the future is going to be. Unless you have a substantial and dramatic change in the way your organisation operates, then it's like as not your organisation will continue to be as profitable or as unprofitable as it has been up to this point in time. Therefore, what does history tell us about profitability of the organisation? The second, and perhaps one of the most significant questions that I continue to be asked as I get around the sector is, what should our targeted profit be? In other words, how much profit should we target, and how do we calculate what that profit needs to be? I'll come back to answer that question shortly, but this is a really substantial and important question, because when we think about commerce, for instance, or when we think about government, some of those profit targets stand out quite clearly in terms of what should be achieved by any organisation. In the not-for-profit charitable sector, tradition, that mythology around not making a profit, and I guess general commentary around the sector makes it much harder to appreciate what the targeted profit should be for your organisation. Then again, how do we communicate with our stakeholders about profit is also a really critical question to ask. So it's fine for me to sit here and say to you that your organisation should make a profit, but that mythology out there about charities and not-for-profit organisations not making a profit is real. And the ramifications from making a profit can be substantial if you don't have an appropriate communications arrangement around your profitability and your profit outcomes with your stakeholders, and explaining how that profit is going to be used and what it's for in terms of building the capacity of your organisation. It's a really curious thing, but if we saw commercial organisations not making a profit, of course we would be very uncomfortable with that. And if we saw them not planning to make profits, then those organisations would very, very quickly fold. In not-for-profit and charitable stakes, though, we tend not to have that expectation, and that has that concomitant impact when you do make a profit, that you find you have to explain yourself to your stakeholders about that. I guess this is a really important element to consider as well, and that is that we should look at profit in the context of consolidated profit versus program and services. Like I mentioned before, some of your programs and services, some of the things you do may not be profitable, but might be really germane or key to your purpose. They might be programs and services that you don't want to give up because they actually provide the outcomes or the service delivery aspects that are really germane to your purpose as a charity or a not-for-profit organisation. But you must at least achieve a consolidated profit across all of your programs. If some programs can provide more profit and some programs provide less profit or none, that's fine. I guess the second point that I want to raise there in relation to profit is all of these things are important considerations, but the board, CEO and others in an organisation must intellectually grapple with this idea about profit and also understand what the cost drivers are for the organisation in order to appreciate those programs that don't make a profit and to ensure that they're as efficient as they can be in the context of the funding or other income sources that are provided in relation to them. So I guess one of the golden questions in relation to this presentation, as I said, relates to profit target and what should that profit target be. First and foremost, when we think about profit, we're always thinking about the margin. And the margin is an important consideration for a number of reasons, not least of which because it gives us an understanding of what our expenses are, what our income and expenses relationship is, and perhaps more importantly, it also helps us to be able to work out what our actual margin achieved is compared to what our target margin might be in order to identify what we call the target margin gap. What does all that mean? It means two things fundamentally. The first thing is that in your financial plan over 3 or 5 years, you should be targeting a margin for your organisation that is going to support that sustainability that I talked about before. But you'll actually have an achieved margin that comes out of the funding levels and other things that provide income to your organisation. I guess the key issue here is that you should be targeting a margin that sustainably makes sense to your organisation and accepting the margin that is actually achieved and using that as a way of identifying your target margin gap and developing your strategies accordingly. So that what I'm saying here, I guess, is it's important not to be constrained by the margin that's actually achieved and to be planning and to strategize around building on that margin in order to achieve the target margin that you need over time. So examples of how you might achieve a margin include things like industry CPI. I think industry CPI is an area of interest, particularly in health-related organisations, so human services, charities, and so on, where we would see traditionally health CPI, for instance, running quite considerably higher than CPI generally. People participating in this seminar would probably recall that CPI is an estimate of the cost increase for people living in a household. That is, what are the cost of living increases for most families around Australia and how much has that gone up either in a month, in a quarter or over a year. Industry CPI, rather than CPI itself, actually looks at the cost components of each particular industry. And I think that's a really important consideration. For instance, in March 2021, CPI was running at about 1% or 1.5%, depending on where you were in the country, while health CPI was running at over 4%. And it's important for your organisation to maintain income levels at least at CPI levels so that you're maintaining capacity to meet your expenses as they expand, because history certainly tells us that your funding will grow much more slowly than the cost of service delivery is likely to grow. So industry CPI is a great example of an area where you might be able to identify an appropriate margin for your organisation as a target margin. Of course, the other thing that you might do in, say, aged care, for instance, is look at some of your for-profit comparators. So for-profit organisations that might be providing services within your sector will also, of course, be generating a profit to return to their investors, and therefore they might be a good point of reference in the context of the kinds of profit that you might want to be targeting. But they might also be a point of reference to be able to reconcile the profit being achieved by your organisation compared to what they're achieving, given that most not-for-profit charitable organisations tend to have a basket of services that range across both profitable and non-profitable service delivery types. Whereas for-profit organisations have a tendency, of course, to look at those profitable services and to leave out those services that are not going to attain a profit in the short, medium or longer term. The other example, of course, is in relation to your financial plan needs, and we talked about this a fair bit in webinar 2 in this series. The financial plan needs over that 3 to 5 year period will help you to identify what kind of profit you need to accrue in the context of, say, philanthropy targets and other targets that your organisation might have, so that your target margin is attuned to and connected to your financial planning outcomes over that 3 to 5 year period and what they need to achieve. I guess the other thing about looking at it in the context of the financial plan needs means that you can slowly build up that target margin and also continue with that communication strategy with your stakeholders to ensure that there aren't any negative outcomes associated with your profitability in the short, medium or longer term. In that respect, I guess taking into consideration the financial plan needs, you need to think about asset replacement and what kind of costs might be involved there. You need to think about change management and what kind of costs are associated with change management as a result of changes in the way funding is provided, improvements in the way services might be provided, or increases in costs and training requirements for your staff, as well as actual change management itself. So when organisations have substantive strategies, they need to consider what kind of investment they need to make in change management in order to achieve the outcome that they're looking to achieve. Without investment in change management, the likelihood of achieving those structural or strategic changes that they're looking to make in order to continue to be sustainable are going to be challenged, in my view. And then, of course, services redesign is that critical part that I talked about before, where funding or where services change, being able to redesign services in a great move from state-based disability services provision to the NDIS is a service design process that's cost a lot of organisations significant in investment arrangements in order to manage that transition and also to be able to rebuild their organisations in the context of the new business as usual. I guess the other element that needs to go in there is that staff development, and that's a really critical aspect because at the end of the day, staff development is an area where often organisations are unable to invest, and there are a number of funded arrangements where staff development is not included in the funding cost that accrues to organisations, but also because particularly in human services organisations, not-for-profits and charities tend to be very, very staff heavy. They are high human resources using organisations, and their services are absolutely dependent on having the right people. So what about the gap? First and foremost, I think it's important that once you've identified that target margin gap, then your financial plan really focuses on strategies for closing that gap. Those strategies need to look at sources of income, sources of allocation of assets, so where you have donations in kind, for instance, and other aspects in terms of making sure your organisation is as efficient as it can be to prevent income going out the door as expenses is also a really important aspect as well. I guess at the end of the day, prioritisation of mission versus profit is a critical element that every organisation has to take in its own terms. And that means that in terms of that mission versus profit, thinking about what the balance is and also thinking about those services and supports that might be provided by your organisation that are unprofitable but are no less absolutely necessary to those people who need them. The final point, I guess, that's really critical here in the context of the gap is also having being able to demonstrate for advocacy purposes the cost versus the funding that's actually provided. And I think increasingly organisations need to think about, as part of their financial plan process, those advocacy issues that are most important to them, and to be able to pass that data and that information both up to their peak bodies, so their industry peak bodies like National Disability Services, Aged Care and Community Services and so on. All of those kinds of organisations need to have that data, but also perhaps even to pass that directly on to your minister or to government in order to be able to demonstrate why you need that, extra support and service and why that profit's important. The other demonstrable aspect from an advocacy perspective is being able to demonstrate to your key stakeholders why that profit is important, and to communicate with them to make sure there are no unintended consequences resulting from your garnering of profit in your organisation and how you're going to use that. Of course, capacity to change I've already dealt with, and I think that is absolutely a critical part of that target margin and that target margin gap. Why I list it here is because often that capacity to change, building the ability into your organisation and investing for change, is not as clear or as obvious as, say, the requirement for you to replace assets or to redesign your services. And therefore, I think organisations need to consider that in the context of it being a less transparent aspect, but also being able to advocate for that change in your organisation. Subsidising government procured service delivery is a big issue here as well. So there is a principle here in the context of organisations being as profitable as possible, but also thinking about whether or not the government procured services that they provide, that is the funding from government to purchase services on government's behalf, may not be priced adequately. And this also means that you need to advocate in order to ensure that the prices developed in to the best outcome for your organisation, but most importantly for those people who rely on your organisation for services and supports. Okay, so I guess the final points that I would like to make in the remaining few minutes before we get to question time, and I'm really hoping that we've got some great questions to talk about in the last 10 minutes of the webinar. But the profit impact is a really important thing to consider as well. There are political and other challenges in relation to what I've been talking about, but in terms of profit impact, you should be, and particularly those volunteer directors of charities and not-for-profit should see in their organisation things like the amount of free cash building. So there's free cash flow coming into the organisation that allows directors, CEOs and others to be able to make decisions about investment and to be able to expand the business and build the organisation effectively. It should also be seen in the building of the balance sheet, so that the balance sheet should be becoming stronger as representative of the financial strength of the organisation that results from the profit that's being achieved. The other element, I guess, that's really important in all of this in relation to the profit and loss particularly, is ensuring that appropriate pricing. So I've already mentioned that it's important to be able to understand what that gap is in terms of funding and margin, and to be able to pass that information on to your sector peaks and to government, but also appreciating what appropriate pricing looks like for your organisation is a really impactful element of being able to achieve profit. In other words, if you're achieving profit, then it's quite likely that you're achieving appropriate pricing for the services that you are providing for your stakeholders. And of course, being able to have a profit means that you are budgeting more effectively in relation to the efficiency of the organisation, in relation to appreciating things like the contribution margin, so the amount of free cash that's generated by services and supports is a really important aspect of this consideration as well. As I mentioned before, though, there are these negative stakeholder consequences that really need to be thought through. And those stakeholder consequences are an important hurdle to being able to make a profit in your organisation, but they must be dealt with. In other words, you can't allow potential negative stakeholder consequences or the beliefs, the mythology that might be out there in the community about whether or not not-for-profit organisations should make a profit to prevent your organisation from being profitable at the end of the day. In other words, there will be and likely to be negative stakeholder consequences. You need to build a strategy to deal with that and a communication strategy to effectively manage that, rather than using that or allowing that to prevent you as an organisation from making a profit. At the end of the day, as I said, that profitability is absolutely critical to your organisation's ability to maintain its sustainability in the terms that I've defined earlier in this presentation. Thanks very much. That brings me to right dot on, I think, to half past the hour. And I hope there are some questions and comments that I can respond to.
Thank you, David. We do have a few questions that have come through, so we might get straight into them. The first one comes from Sarah, and Sarah asked, "What do you suggest finding where do you suggest finding financial advisors with not-for-profit familiarity and skills? We've approached a number who will only advise on managed funds and cannot or will not advise on property as a part of the asset mix."
Look, that's a really good question, an important one, and I'd be very happy to take that offline and talk about it a little bit more. But there does tend to be a separation between financial advisors that look at financial products as opposed to property advisors, and perhaps that is something that you need to consider, but perhaps that's something to take offline and have a bit of a broader chat about if we can.
Great. The next question we have here is from Craig, and Craig asks, "My question for you is, how can organisations use their financial statements to help explain to funders and supporters why it is okay that they make a profit?"
Okay, that's a really good question. So I think there's a number of responses to that question, or rather a number of elements to that question, but I might try and keep it short for the sake of time. But I think there's three things that you really need to do. The first thing is sharing your budgets at different levels. You don't have to share every cent and how everything works, but you can certainly share your budgets with your stakeholders so that the budget outcome is expected of by them. In other words, sometimes it's really useful to be able to forecast what's happening and then report accordingly, rather than, for want of a better phrase, them being surprised by a level of profit that they weren't expecting in your organisation. So sometimes that communications process can be really effective when you allow for people to understand what your plans are. The second thing is on the face of the balance sheet, so the actual balance sheet itself, you actually have a descriptor of what some of that cash might be used for. For instance, it's often good management, not always, but often good management for organisations to put sufficient cash aside and to be able to cover off their employee entitlements, so long service leave and annual leave. And so having a reserve of cash for that purpose should be described accordingly so that people can read the balance sheet and understand why there might be cash deposits set aside, and that to understand and appreciate that those cash deposits are actually identified for particular uses. The third thing that you might do, and again, not necessarily at the very, very lowest level or the most minutiae level, but you might share your 3 to 5 year financial plan with stakeholders as well, and indicate to them that over 4 years you're going to make a profit of a certain amount of money, and on the 5th year you're going to invest that in asset replacements or in a particular project or a particular process. In other words, making it simple and obvious to those stakeholders why you're collecting that profit and what you're doing with that profit over time, rather than being, I guess, allowing yourself to be hedged in or confined to reporting on an annual basis, which accounting reports require. So that also means that you might use the commentary in your annual reports to talk about profitability and the kinds of objectives you have for building your balance sheet in the short to medium term.
Great, thanks, David. Our next question here comes from Justin, and Justin asks, "How do you recommend we factor in the cost of growth? Setting hurdle rates can help explain why we have a profit one year and less another."
Yeah. So in your budgeting process, you should be factoring in growth. And I suggested that one of the margins, one of the things that you might use to develop a margin for your organisation is things like the health CPI. And I mentioned that that health CPI was running at something over 4% up to the March quarter this year. So I think you look at your targets in the context of what costs are going, what cost rises there are happening, and also what the forecast of your budget is going to be over the 3 to 5 years of your financial plan. And the 3 to 5 years financial planning process, I think, is absolutely critical, because obviously you update that on an iterative basis as you move forward and as things become known. But at the same time, you really need to be able to demonstrate that your costs are increasing and that that profit's going to be critical to build cash reserves and do the things that you need to do going forward. So I'd look at health CPI, I'd look at CPI generally, I would look at the wage-weighted index, so the proportion and the values of wages as they go up in your particular state or territory. And I'd also look at that 3 to 5 year financial plan and what's required in order to ensure sustainability moving forward.
Fantastic. And another one here. Do you think governments understand the need for not-for-profits to make a profit? Is there a risk that government as funders see profits and cutbacks on the basis of a perceived needs basis?
No, I don't think governments do understand, and I think there's 3 reasons for why they don't understand. I think the first reason is because there is a general mythology out there that not-for-profits are called not-for-profits because they don't make profit, whereas of course we know that not-for-profits are called that because the stakeholders, the members, aren't entitled to receive a profit from these organisations. The second reason is because the not-for-profit sector and the charitable sector, to be frank, have not advocated effectively for to inform government and other stakeholders as to why profit's important. They've always felt that this is a really difficult thing to do because they feel that it won't wash with the general community. But I think a longer term view is really important here, and that they should be thinking very, very closely and very, very clearly about advocating for the need for these organisations to make profit. The third reason is that governments don't budget in a way that considers the cost of service delivery. They budget in the context of how much money is available and in the context of their historical rolling budget. So budgets are not zero-based budgets each year for government. They're actually building on previous budgets and previous myths around what the funding should be for certain things. So for instance, in human services, it's very rare for government to actually find out what human services delivery costs for an appropriate service. Rather, they just simply make money available, and it's up to organisations to try and cut their cloth accordingly. So I think governments don't appreciate the need for profit, but what's more important, I think, is that commerce don't appreciate the need for not-for-profits to achieve profit, and a lot of commentators and a lot of people involved in the industry level don't appreciate that need either. And so I think there's a massive opportunity for an ongoing commentary around the need for profit in this sector and why that profit's important for sustainability going forward. Even from government's perspective, profitability is critical because government doesn't want to be left holding the baby if organisations collapse. And that's typically what happens. If an organisation in human services collapses through want of funds or financial resources, then government typically has to get its wallet out, and it costs a lot more to resolve the issue. So prevention is much better than cure.
Thanks, David. And a quick one here is if anyone wants to get in contact with you, how can they best do that?
Okay, so the contact details are on the screen there. And also, if you just Google David Gilchrist at UWA, it'll come up with my contact details, and I'll be delighted to chat with anyone, of course, in relation to this or other issues around not-for-profits and charities.
Fantastic. Well, that is all we have time for. So thanks, David, for your time and your insights, and thanks everyone for attending today's webinar. A big thank you also to Commonwealth Bank Australia for your continued investment into the not-for-profit sector. There is a survey at the end of this webinar, so it'd be great if you could fill it in to help us with the future webinars. Thank you again to David, and thank you all, and enjoy the rest of your day.
Thank you very much.